Okay, so during the last class, we talked about the agency benefits of using debt. Um, so the basic idea is the use of debt can reduce wasteful investment and can preserve ownership concentration. And then the more complicated part is about this reducing wasteful investment. So the idea is CEOs or managers, they have this empire building preference, right? So they wanted to build a larger firm. Even doing this will harm investor uh, value. And then it's also possibly that managers they are overconfident, so they could invest in negative NPV projects. So using debt, which will put a pressure on these managers, and using debt, it will also reduce the free cash flow available to these managers. So the use of debt could provide the benefits of reducing wasteful investment. And then we also talk about this pecking order hypothesis. The main result of this pecking order hypothesis is managers will first prefer to use its retained earnings, and then it will use debt. And managers will only use equity as a last resort. This idea is based on this asymmetric information. Um, Basically, asymmetric information refers to the case that managers know more about the form. Sorry. Basically, asymmetric information refers to the case that managers know more about the firm compared with shareholders. So we discussed two topics. The first topic is about leverage as a signal. That is, if the firm wants to signal to its shareholders it has a good investment, it has this good future, it has this good prospect, then it could use the leverage. The idea here is if the firm does not have a good investment, then the firm will not be able to afford a large amount of debt because doing so could result in a default or bankruptcy. So this basically implies that if a firm is using a large amount of debt, then this firm is having good investment or this firm is having this good prospect. So this is the idea that why leverage can act as a credible signal. And then the second topic, which is more complicated, is adverse selection. We start with this used car market, and we find out in the end only bad cars will be left in the market for sale, and these car buyers they will only pay this low price for bad cars. This same logic will also be applied to this equity market. So basically, due to adverse selection, right? Buyers will consider firms issuing new equity as lemon firms. Just like in the car market, if you're selling your car as a car buyer, I will conjecture that you're selling a lemon car. So in the equity market, if you're a firm who is selling your equity, then I would conjecture you're a lemon firm. Right? So possibly I would say, or I would guess, well, this firm is selling its equity because this firm's managers are just trying to cash out before negative information hits. Right? Potentially, after I purchase the equity from this firm will suffer from a loss or a bad corporate event. Right? In this case, you can see that as an equity buyer, if I consider this firm as a lemon firm, I will only want to buy the new equity at a lower price or at a discounted price. So basically, you can see that in this equity issuance market, only bad firms will be willing to sell new equity. And this has an important implication. This implies that if there is a good firm who is willing to sell equity, then this good firm will be considered as a bad firm. So its equity will still be underpriced. Right? So the result here is adverse selection will generate underpricing of firm's equity. Now let's see this very interesting example, which will help us to understand this adverse selection and underpricing of equities. So this firm Puchatek is worth either 180 or 60, and investors believe each case is equally likely. So basically, investors has a belief of possible outcomes. So $100 or $80 or $60, and investors put equal probabilities on these different possible stock prices. So now you can see that the expected stock price would be the average of these three numbers, which is $80. Now let's say the CEO of this firm announces he will sell most of his holdings to diversify, and diversification is worth 10% of the share price. That is, the CEO will be happy to receive 10% less than the shares are worth to achieve the benefits of diversification. If investors believe the CEO knows the true value, how will the share price change if he tries to sell? Will the CEO sell at the new share price? Okay. So basically the problem says the CEO wants to diversify. The idea is generally a lot of, or the majority of this CEO's wealth is concentrated in this firm's equity. So from the perspective of diversification, the CEO will want to reduce this concentration. So the CEO will want to sell some of the firm's equity. Right? And the problem says the diversification benefit is worth 10%. So this basically means that if the true stock price, if the true stock price is 100, so if the true price is 100, then let's see what is the lowest price the CEO is willing to pay. Sorry, what is the lowest price the CEO is willing to sell? Well, we know that the CEO is happy to sell by taking this 10% discount. So the lowest, price the CEO is willing to sell is 100 times 1 minus the discount, $90, right? And now the market price is actually 80. So if the CEO says, hey, I am happy to sell at $80, then investors will understand that the $100 true price is not possible. Again, let me repeat. So if the true price is $100, then the CEO, or the lowest price the CEO will be willing to sell his equity holding, is $90. However, if the current market price is 80, and the CEO tells these investors, I am happy to sell at $80, this implies that the true price of 100 is not possible, right? So basically this implies that investors will update their beliefs, right? So now they will consider something like this. They will consider that there are only two possibilities. And again, let's say these investors would put equal probabilities on these two outcomes. So in this case, the expected price would be 70. Now, let's say the CEO tells these shareholders, hey, even at $70, I am still happy to sell. Now let's see what will happen. So again, the logic here would be the same. If true price is 80, right? So what is the lowest price the CEO is willing to sell? Again, the CEO will take this discount, right? So it's 80 times 1 minus this discount. So it's $72. So this basically means that if the CEO tells these shareholders, hey, I am happy to sell at $70, shareholders will understand this $80 is impossible, right? So this basically means in the end, investors will understand 60 is the only possible price. So in the end, if this CEO still decides to sell at $70, stock price will drop to 60. And investors will, for sure, or with 100% probability, to know that the true price is 60. Right? So this is the end result. So, what's the takeaway here? So the takeaway here is, if the CEO decides to sell his equity, then his behavior of selling equities will convey negative information about this firm, right? So basically, you can see that if at the price of 80, the CEO decides to sell, the investors will understand this 100 is not possible. So the share price of the firm will drop to $70. Again, at $70, if the CEO still decides to sell, this is again a negative information. So investor will conjecture that investor will conjecture that this $80 outcome is not possible. So investor will finally know that this is a bad firm with a share price of any $60, right? So this again is just the same story of adverse selection. Okay, what kind of conjectures or predictions we can get from this this adverse selection theory? Well, we could have some implications for equity issuance. So the first implication we can get is the stock price declines on the announcement of a new equity offering. Why? Well, because as we have discussed, if the firm announces it will offer new equity, then this will contain bad information or bad news for investors. Investors will consider this firm as a lemon firm, so the share price will decline. The second implication is the share price tends to rise before the announcement of a new equity offering. The idea is, if the firm offers if the firm offers new equity, investors will consider this action as a negative sort of information. That's bad language. Okay, so let me rephrase this. So basically, if a firm decides to issue new equity, this action will convey negative information. And firms, they understand this. So they will try to mitigate this negative effect. So how firms can mitigate this negative effect? Well, they will try to announce the equity offering after some positive news. Right? So the arrival of this positive news will help reduce this negative effect of new equity offering. Now, the third implication is firms, they would issue equity when information asymmetries are minimized, such as after earnings announcement. Okay, let me explain this implication here. So what is the fundamental cause that there is adverse selection? Well, it's really because there is asymmetric information, right? It's really because sellers, they know more about their products compared with buyers. So this will generate adverse selection. This basically implies that if there is larger information asymmetry between sellers and buyers, then adverse selection will be more severe. This basically means if there is smaller information asymmetries, then adverse selection will be smaller. So this implies that the underpricing of equity will also be smaller. So basically firms, they want this underpricing to be small. So they will try to issue equity when information asymmetries are minimized. Right? Now let's think about this. When information asymmetries are minimized, well, think about how firms issue per quarter results to their shareholders, right? So every quarter there would be this earnings announcement. And during this earnings announcement, the firm will basically present all kinds of financial results to shareholders. And these firms will also talk about their businesses, their investments, and they will also offer some forward guidance, right? Telling investors what could the firm's future looks like. So basically, you can see that during the earnings announcement, the information asymmetries between firms and shareholders will be minimized. So essentially, after this earnings announcement, firm is getting the best time to offer its equity, right? So that's why you get this third implication here. Okay, let's see this empirical result. So for the horizontal axis, you have days relative to equity issuance announcement. So for this day 0, it basically means it's the announcement date, right? That is, on this date, firm announces it will do this equity issuance. And then this minus 200 basically means 200 days before this announcement day. And then for this vertical axis, we have this return relative to the market. So what you can see here is before this announcement date, right, we have this increase in the share value, right? So this basically is consistent with implication 2. That is, the share price would increase before the announcement of a new equity offering. So let me write it here. This is consistent with implication 2. Now what about this? This one basically says if the firm announces its equity offering, then on that day, its share price will be on average decline by 3%. So this is consistent with implication 1, right? Because implication 1 says the share price would decline if the firm says, hey, I will want to offer you some new equity. Okay. Now, what are the implications from the adverse selection for capital structure? Well, basically you can see that first, we would know that equity is underpriced. Right? And then if you think about financing, other than equity, a firm can also use debt, or it could use its own retained earnings. Right? So for debt, generally, the information asymmetry between firms and debt holders is smaller compared with the information asymmetry between firm and shareholders. So this implies that debt will suffer from smaller degree of adverse selection. Right? So this also implies that underpricing of debt will be smaller compared with equity. Right? This basically means that if the firm is thinking about using debt versus equity, then using equity will incur a larger cost or a larger underpricing cost. And then if you think about retained earnings, right? So in this case, the firm is using its internal cash to make new investment. And in this case, there is no underpricing at all, right? Because using retained the earnings does not involve because using retained earnings does not involve debt holders or shareholders. So information asymmetry does not play a role, right? So this basically means that from the perspective of underpricing cost, equity has the largest underpricing cost. Debt has a smaller underpricing cost, and cash or retained earnings, they do not have underpricing cost. So clearly this will imply our pecking order hypothesis, right? So basically this implies that if managers they think their firm's equities are underpriced, then they will first use retained earnings. After that, they will try to use debt. And they will only use equity as a last resort. And the opposite to the pecking order hypothesis is also correct. So basically it says if managers consider their firm's equities to be overpriced, in this case, they will prefer to first use equity, then they will use debt, then they will use retained earnings, right? Okay, so we can look at the empirical results, right? So if we look at the data, we can see that our observations from the data are generally consistent with this pecking order hypothesis. So if you look at this picture, it basically discusses sources of financing for CapEx, for Canadian firms from 1970 to 2012. So let's focus on these three components. So here we're looking at cash. This one is equity. So this one is debt. Now what you can see here is for most years, right, the largest component of financing is cash, right? These bars, these blue bars, right? These blue bars. And then the second largest source is actually debt, right? Debt, there are these, sorry for that. Debt, they're represented by these red bars, right? And then you can see that the shortest bar among these three sources of financing is equity, right? These dark green bars, right? And you can see that this pattern is generally consistent across different years. Okay, let's see this example here. So Exxon Industries needs to raise $10 million for a new investment project. So the firm issues 1-year debt, and it has to pay a interest rate of 7%. Even though the managers of the firm believe 6% would be the correct rate. Right? If the firm issues equity, they believe the equity may be underpriced by 5%. So what is the cost to current shareholders of financing the project using retained earnings, debt, and equity? So let's see the first form of financing, which is retained earnings. So if the firm uses its internal cash to finance this new project, then its cost is just $10 million. Second, if the firm uses debt, you can see that say it wants to borrow a cash of $10 million. At the end of the year, it has to pay back 1 plus 7% times 10, right? Because the interest rate is 7%. Now, what is the present value of this future debt? Well, it's just this 10 times 1 plus 7% divided by 1 plus 6%, right? So again, you can see that this numerator is the future amount of cash the firm has to pay back to its debt holders. And then if you divide this amount by 1 plus 6%, you will get the present value of this debt, right? Here you can see that you would use 7% in the numerator because you have to pay this 7%. And then you would use 6% in the denominator because 6% represents the fair rate given the level of risk. Right? So 6% is the correct discount factor. So don't confuse by these two numbers. Right? And then this gives you a number of 10.094. Now the third type, which is easy to calculate. The third type of financing is equity. And we know that the equity would be underpriced by 5%. So what does the word underpriced mean here? Right? Well, it means that if you want to raise $10 million of cash, and if your equity is underpriced, then you have to give more than $10 million of equity to shareholders in exchange for $10 million of cash, right? So let's say you have to give this amount of equity in exchange for $10 million of cash. If there is underpricing, this means E minus 10 divided by 10 equals 5%. So this implies it would be, let me see, 10.05? Yeah, it should be 10.05 or 10.5. Oh, sorry, it's 10.5. Okay, so it's 10.5. So basically you can see that in this case, there is underpricing. That is, you give $10.5 million of equity to your shareholders, and you will only get back $10 million of cash. This is exactly underpricing, right? Okay, great. Now it's very easy to answer the question here. What is the cost? Right, so you can see that the cost is the largest if the firm is using equity, right? Then the debt is second largest. And obviously, if the firm is using retained earnings, then the cost is actually smallest. Okay, let's summarize this chapter. So we basically learned about two major types of theory, how the firm determines its best capital structure. Right? The first theory is the trade-off theory. So basically the firm will trade off benefits and costs of using debt. For benefits, we have two kinds of benefits, right? Interest tax shield and agency benefits. And for interest tax shield, it's important for you to understand how to correct value interest tax shield and how the interest tax shield will actually increase firm's value. And a important application is the leveraged leveraged recapitalization. And then agency benefits, right? Basically means that debt will help to reduce wasteful investment and preserve ownership concentration. Now, what are the costs? Well, the first one is financial distress cost. It basically means that if you have too much debt, then possibly you will have some difficulty in repay these large amounts of debt. So you would be in default, or you would potentially file for bankruptcy, and these will create costs, which are called financial distress costs. And then we also have this agency costs. We have three major types of agency costs, right? The first is asset substitution. This will result in, overinvestment and over the risk-taking behavior from shareholders. And then the second one is debt overhang. In this case, these shareholders, they will not finance positive NPV projects. So this will lead to underinvestment. And then a more extreme form of debt overhang is called cashing out. That is, shareholders, if they know the firm will file for bankruptcy in the end, then they will actually first start selling some of these firms' properties, right? Or some fixed assets to pay themselves a large cash dividend. So this is called cashing out. And then based on the argument of asymmetric information, we discussed pecking order theory. So the result is because of the presence of asymmetric information between firms and shareholders, there will be adverse selection if the firm issues equity. So this implies that equities will be underpriced. Now, if equities are underpriced, then managers, they will first use retained earnings, then use debt, and they will only use equity as a last resort. But you can see that even if we understand the optimal capital structure theory, in reality, firms, they may not choose an optimal capital structure. There are two reasons for this. The first is because of management entrenchment. So the idea here is when a firm is determining how much debt and how much equity to use, these decisions are made by managers, by CEOs, by CFOs, right? And obviously, when they're making these decisions, their decisions will not always be the same as shareholders' decisions. So, for example, maybe they will want to choose the amount of debt which will avoid the discipline of debt, right? That is, they want to reduce the amount of debt because in that case, they will have higher free cash flows, then there will be no threat of bankruptcy, so they could do whatever they want, right? So due to this management entrenchment, then possibly the firm's optimal debt level will actually deviate from this optimal level. The second reason is due to transaction costs. Well, the reason is because if a firm tries to adjust its capital structure, let's say a firm wants to get more debt, in this case, the firm will have to either borrow from a bank or issue some corporate bond. In both cases, there are transaction costs. So the firm has to make sure the benefit from changing capital structure is larger than the cost of changing capital structure. So obviously, a firm will only want to modify, will only want to change its capital structure when the benefit is larger than the cost. So sometimes, even if a firm's capital structure deviates from the optimal level, it will not want to make any adjustment because the cost potentially is large. Okay, now let's review this chapter. So it says first, it asks, does the risk of default reduce the value of the firm? Well, the answer is no. Because we're only talking about risk. So it's the cost of default which reduces the value of the firm. The risk itself does not reduce the firm's value. Okay, second, true or false? If bankruptcy costs are only incurred once the firm is in bankruptcy and its equity is worthless, then these costs will not affect the initial value of the firm. So the answer here is this statement is false. Basically, on the surface, it looks like bondholders, they would suffer from bankruptcy costs. However, if debt holders, they're expecting this bankruptcy cost, then they will actually pay lower amount for this firm's debt. This implies that the firm will raise smaller amount of cash. So this basically means there will be smaller amount of cash available for this firm to make new investment due to this bankruptcy costs. So in the end, this will hurt shareholders, and this will reduce the initial value of the firm. Okay, third, what is the trade-off in the trade-off theory? We just talked about this, right? So when you're talking about trade-off theory, then you're really thinking about two benefits versus two costs, right? Two benefits refer to interest tax shield and agency benefits, and two costs refer to financial distress cost and agency costs. Fourth, why do firms have an incentive to both take excessive risk and underinvest when they're in financial distress? So here we are essentially talking about asset substitution and debt overhang, right? So for the first case, we are talking about asset substitution, and the second case, we're talking about debt overhang. Okay, six. In what ways might managers benefit by overspending on acquisitions? So this is related to empire building, right? So if the manager spends a lot of money to acquire other firms, this will make his own firm larger. And a manager enjoys or prefers a larger firm, because when a firm becomes larger, the manager will benefit by having higher compensation and more media exposure and higher or better reputation from managing a larger firm, right? So this will benefit the managers. Seventh, describe how the management in entrenchment can affect the value of the firm. So if you recall what we discussed in this chapter, I would say there are two perspectives you can talk about this. The first perspective is from the perspective of the agency benefits, right? So if there is management entrenchment, then these managers, they can make wasteful investment. So you can see that in this case, wasteful investment will reduce firm's value, right? And then the second perspective is from the perspective of using optimal level of debt. Well, we know that debt will provide some incentive or will provide some disciplinary effect on managers, right? So basically, if there's debt, then if the manager tries to make some wasteful investment, then the firm could file the firm could file for bankruptcy due to this wasteful investment. So this basically means that if there is managerial entrenchment, these managers, they will try to use lower amount of debt. In this case, there will be no threat of bankruptcy, right? So because there is no threat of bankruptcy, then these managers will be free to make wasteful investment. This could reduce the firm's value. So to summarize, managerial entrenchment will reduce the value of the firm, right? Okay, ninth. So Coca-Cola is almost 50% debt financed, and Intel, a technology firm, has no net debt. Why might these firms choose such different capital structure? So this is related to the trade-off theory, right? So when you're thinking about these firms, you will think about how they could fit into different categories of this trade-off theory, right? So for example, if we talk about, let's just pick one, right? Let's just pick the bankruptcy cost. Okay. Oops, why I cannot? Okay, my Apple Pen does not work. That's weird. Oh, okay, great. It finally works. So let's just pick one, right? So we pick bankruptcy cost. What I can see here is Coca-Cola should have lower bankruptcy cost compared with Intel, right? Why do we have this conclusion here? Well, the result is, well, the reason is Coca-Cola is a very mature, low-growth firm. So this firm should have a lot of fixed asset. So in the event of financial distress, Coca-Cola can basically potentially sell some of its fixed assets. In this case, it will be easier for Coca-Cola to meet its debt obligations. So this implies that Coca-Cola will be willing to use more debt due to lower bankruptcy cost. And let's just pick a different one, right? So let's pick what else? Agency cost. Now here you can say something like this. Well, Coca-Cola is a mature firm, so it does not have a lot of exciting projects or investments. So this implies that Coca-Cola potentially, possibly, has high level of free cash flows. So in this case, Coca-Cola should take on more debt, right? Because debt has agency benefit. And then for Intel, right? You could say maybe Intel is a high growth firm. It does not have a lot of free cash flows, so it does not need the debt to serve this role of agency benefits. Okay. Now let's talk about the 10th. So the 10th question asks, why might firms prefer to fund investments using retained earnings or debt rather than issuing equity? Well, this is just this classic result about pecking order theory, right? So let me say this again. So basically, it's because there is information asymmetry between firms and shareholders. So this will cause adverse selection, which means equity will be underpriced. And because equity is underpriced, then firms will prefer to first use retained earnings and debt. Now, 11th, what are some reasons firms might depart from their optimal capital structure, at least in the short run? Well, we talk about this, right? There are two reasons. The first is due to managerial entrenchment, and the second is due to this transaction cost. Okay, I think this is the last question. Okay, great. So let's move on to the next chapter, which is about payout policies. So what's this chapter is trying to tell us? Well, it tries to tell us how the firm should pay its cash back to shareholders, right? So here we have a nice picture which tells you if a firm has some free cash flow, how this free cash flow could it be used, right? So first, on this left, first, on the left, you can see that the firm could retain this free cash flow, right, as retained earnings. In this case, the retained earnings can be used to finance new projects, or it could be used to increase the firm's cash reserve. Right? And on the right, the firm can just simply pay out the free cash flow to its shareholders. And there are two ways to return cash to shareholders. The first is to do a share repurchase. So in this case, the firm is basically use its cash to buy back shares from its shareholders. The result is cash will go to the pockets of shareholders, and the number of shares in the market will be reduced due to this share repurchase. And a firm could also pay dividend, right? So if the firm pay dividend, then the cash will be in the pocket of these shareholders in the form of dividend. So let's first talk about the mechanics of dividends. There are four related dates about dividends. The first is this declaration date. Okay. So that declaration date is the date when the firm declares there will be a dividend. Okay. So this is very easy to understand. Then the second one is the ex-dividend. So here, ex basically means no or without, right? So this is the without dividend date. It means that if you buy the share on or after this date, then you won't be able to get the dividend. And then we have this record date, which means if you're the shareholder on this date, then you will be able to receive the dividend. That is, when a firm pays a dividend, only shareholders on record on this date will receive the dividend. Okay, so that's why this is called record date. You have to be on the record to get your dividend. And then we have this distribution date, which is also called payable date. So distribution date basically means this is the date the dividend will be actually distributed to you, right? So if you look at the timeline, then you will first have this declaration date. And after that, we have this ex-dividend date. And then we would have this record date. And last, we have this payable date. So this is an example for Microsoft. So basically, Microsoft declared on July 20th, 2004, it will pay a special dividend of $3 per share. And then the ex-dividend date is set on November 15th, 2004. So it basically means if you buy Microsoft on or after this date, then you won't be able to get the dividend. And then November 17th, 2004 is the record date. That is, if you're on record on this date, then you will be able to get the dividend. And last, we have this payable date, which means on this day, you will actually get your dividend. Okay. So generally, most firms, they will pay dividend every quarter, right? And generally, the amount of the dividend will be quite constant. You will not see, you won't see large variations. And there are several kinds of dividends. One type is called special dividend. Well, just from the name, you would know that this guy is special, right? Why it is special? Well, it's just a one-time dividend, right? And this one-time dividend is generally larger compared with the regular dividend. So why do firm want to use this special dividend? Well, possibly the firm had some windfall, right? In this case, the firm maybe got a large amount of cash. So now the firm really needs to get rid of or distribute this large amount of cash to its shareholders, so it could use a special dividend. Okay, now we also have this third type, that is a stock dividend. So in this case, the firm is just issuing additional shares rather than cash to its shareholders. You can just from this, you can see this from the name, right? Most of the time, when people are talking about dividend, they are talking about regular cash dividend. That is, here regular means this dividend will be paid out every quarter in very constant amounts. Cash means you will actually get money, right? And special means, well, you will get this one-time large amount dividend. Then this third stock dividend means that the dividend will be paid in the form of shares instead of cash. Okay, now let's see a example for now let's see a example of this dividend history, right, for General Motors. So it's for 1983 to 2008. What you can see here is first, you can see that dividend per share is actually pretty consistent, right? Oh gosh. Oh, sorry for that. My iPad is acting weird. Ah, boy. What is happening? Okay, let me reopen this file. Okay, great. So what you can see here is the dividend amount has been quite constant, right? So you can see that at least during this period, you have this constant dividend payoff. And in other different years, you will see that the dividend amount will only be changed like every, 7 or 8 years, right? So you can see that here you have this constant dividend. And then you will see jump here and jump here, right? So this tells you that for regular cash dividend, the amount is actually quite consistent, right? And then you have this special dividend. These two guys, and you can see that among the history of more than 20 years, there are only 2 special dividends. And you could also see that special dividends is much larger compared with regular dividend, right? So you can see that regular dividend is only about 50 cents. And for special dividend, you get 3.27 and 13.72. Now let's talk about share repurchase. First, share repurchase basically means the firm is using its own cash to buy its own shares back. There are 3 ways the firm can buy back its shares. The first is open market repurchase. The second is tender offer. The third is targeted repurchase. So, open market repurchase basically means the firm repurchases its shares from the open market. And this is the most important form of share repurchase. You can see that the open market share repurchases represent about 95% of all repurchase transactions. And then the second one is tender offer. So this is like a form of auction. So basically the firm will offer to buy shares at a pre-specified price. And in this case, if shareholders they do not tender enough shares, then the firm could cancel this offer and no buyback will happen. Or the firm could use this Dutch auction. So in this case, the firm will tell its shareholders what kind of prices it will want to buy how many shares. And then shareholders will tell the firm how many shares they are willing to sell at each price. So in the end, the firm will pay the lowest price at which it can buy back its desired number of shares. The third type is the targeted repurchase. So just from the name, right? There's a target. What is the target? Well, it's a major shareholder. So targeted repurchase basically means the firm will repurchase its shares directly from a large shareholder. So in this case, the purchase price is negotiated directly with this large shareholder. Okay, now let's compare using dividend and share repurchase. So the question here is we want to ask if a firm has these two choices, right? Using dividends or using share repurchase, then which choice should this firm prefer to use? Now let's first start from a perfect capital market. So you can imagine that in this perfect capital market, the firm should be indifferent between using dividends and using share repurchase, right? Because again, this is basically a extension of theorem. It's a perfect capital market. So these different forms of financial transactions do not create value or destroy value. So the firm's value will not be affected by using either dividends or share repurchase. So the firm should be indifferent between these two choices. So let's see a very simple example to verify our conjecture. So let's say we have a firm and this firm wants to pay out $20 million in excess cash to its shareholders. And in the beginning, let's say this firm, Jinrong Corporation, has no debt and its equity cost of capital is 12%. The firm expects to generate future free cash flows of $48 million per year. Okay. Now let's say the first choice of the firm is to just use cash to pay the dividend. Okay, let's see. In this case, the firm has $20 million of cash, right? So $20 million of cash. And number of shares is given by 10 million shares. So you can see that dividend per share would be 20 divided by number of shares, which would be 2. Right? So every share will receive a $2 dividend. Right? And you can see that the firm in the future, we'll have $48 million of cash every year. So you can see that in the future, the firm's dividend per share will be given by 48 divided by 10, which is 4.8. So let's see the firm's share price. Let me first draw the timeline here. So according to our calculation, right, on day 0, the dividend would be 2. On day 1, the dividend would be 4.8. So this is basically D1. And D2 would be the same, 4.8. So we will always get this 4.8. Now, what is P0? Oh no, sorry. I should not say what is P0. So what is the firm's share price before paying out dividend? Right? So we can see that we want to ask what is firm's share price before payout the dividend. And note that here we are actually looking at the firm's common dividend equity price. The reason is because before this ex-dividend date, the share is set to be common dividend, that is with dividend. Because you can see that before this day, anyone but this share will be able to get the dividend. So we could call this price as PCUM, right? So this is the common dividend price. And then we also want to look at a different price, that is the firm's share price after paying this dividend. And you can see that now after paying this dividend, then this is this ex-dividend price, right? It means that you won't be able to get this $2 dividend. So we will call this price as PX. Okay, so let me summarize. So basically PCOM means share price before paying out dividend. So PX means share price after paying out dividend. Now let's do the calculation here. So the common dividend price is given by the first dividend plus the next dividend divided by the equity cost of capital, right? So we are basically using this dividend discount model. And you can see that from the first dividend, we are having a perpetuity here because we will always get this $4.8 and we will get this $4.8 forever, right? So this would be 2 plus 4.8 divided by 12%, which would be 42. And what is the ex-dividend price? That is this guy here, right? So you can see that this is very easy to calculate. It's just D1 divided by 12%, which is, which is 4.8 divided by 12%, which is 40. Now, if I write down these two numbers, I would see that PEX would be 40. PCUM So PCUM would be 42. And then dividend is just 2. What you can see here? Well, you can see that the common dividend price, right, is 42. X dividend price is 40. You can see that there is a $2 drop in the share price. And this $2 drop is exactly the same as the dividend, right? So we will get our first result. That is, in a perfect capital market, when the dividend is paid, the share price drops by the amount of the dividend, right? So you can see that we pay this $2 dividend, then the share price will drop exactly by $2, right? And you can also verify this result using this simple table, right? So on this common dividend date, that is on this date, if you buy the share, then you will be able to get the dividend. So you can see that the firm has not paid out its $20 as dividend. So the firm's total market value would be 400 plus 20. So it's 420. And we know that the firm has actually 10 million shares. So the share price would be 42, right? Oh, by the way, how do we get this 400? Let's see if we can get this 400 here. Did we get this 400 here? Oh, no, we don't have this. So how do you get this 400 here? Well, you can see that this 400 is actually given by this. So you have $48 million per year, and your cost of capital is 12%. So you can directly value this firm's equity, which is given by 48 divided by 12%, which is 400, right? And you also have this 20 million cash. So the total market value would be 420. This will give us the share price. That is, the share price equals 400 plus 20 divided by 10. Divided by 10. So this gives us 42. And then you can see that on this X dividend date, the cash will be paid out as dividend. So we will have a 0 here. And then we will still use this same valuation, get this $400, right? So the total market value would be 400. And now the share number would be the same, 10 million shares. So we get $40 X dividend share price. So PEX would be 400 divided by 10, which is 40, right? So it's actually very simple. It's a very typical valuation exercise. Okay, that's for today's class.